Whether it's your grocery basket or your electricity bill, inflation can quickly squeeze your budget and eat away at your savings. To maintain purchasing power for retirement, you'll need an investing strategy that hedges against inflation. Hello, my name's Chris Kovalchuk, and I'm a portfolio manager at Claret Asset Management. And today, I'll explain how you can shield your investments from inflation. According to a 2022 study by Jeremy Siegel of the Wharton School of Business, real returns on stocks have remained consistent in the long run, even during periods of high inflation. In fact, there's plenty of research that suggests inflation has little effect on the long-term returns of stocks. So how do stocks allow investors to fend off inflation? We know common stocks represent ownership in a company and a share in its generated profits. The more money a company makes, the more it can distribute to its shareholders. A stock's value is determined by the sum of its future profits evaluated in today's dollars. When inflation is high, most companies pass along increased costs to consumers by raising prices on goods or services. When sale prices rise to maintain profits, profits also increase in absolute dollar terms. In other words, if profits grow, stock prices trend upwards too. This mechanism makes common stocks an excellent tool to counter long-term inflation if they are able to pass along increased costs to the consumers. Though investing in stocks can help counter inflation in the long run, investors should know it's not always straightforward in the short term. There are three factors that can delay the relationship between inflation and increases in stock price. First, when inflation becomes strong, central banks will try to curb inflationary pressure by raising interest rates. Rising interest rates will eventually make bonds or cash more appealing than common stocks. With higher rates, the stock's supply and demand balance gets impacted, as some invested amount will shift from the bond market at the expense of the stock market. Second, when interest rates go up, the cost of capital temporarily becomes more expensive, making it pricier for companies to fund new projects, thus reducing growth prospects. Finally, even if companies can raise their prices to offset cost hikes, there's a delay before these increases cycle through to sales and can be observed in the income statement. Inflation might seem detrimental to the stock market in the short term, especially as a result of rising interest rates and time taken for a sales cycle. But it also allows companies to raise prices and maybe profits. Bigger profits will eventually support stronger stock market performance, at least sufficiently enough to offset the impact of inflation. Thanks for watching. For more investment tips, visit our website at claret.ca or get in touch with us directly by clicking on the links in the description. And don't forget to click the subscribe button below.